Let's start the session. So, welcome to all the participants for the quarterly update on ASK Specialized Portfolio. So, this is from ASK side, which we have been regularly updating what's happening on the portfolios, and any questions which have the clients also can hear that they can put the chat box. We can take it to all the curated questions to Mr. Gagan. So today we have Mr. Gagan, is the portfolio manager for ASK Specialized Portfolio. He has a very vast experience in the financial field, about 18 years. At the same time, he has been worked with the different institutions like Kotak and different alternative investment funds, and is also has worked with the Paris-based AMC for almost 4 years. So he has also worked with the BNK Securities for 7 years as an equity analyst. So Gagan has a postgraduate degree in finance from Department of Financial Studies, Delhi University. So he has joined the ASK is about 2021. It's been 3 years has been with in the portfolio. So Gagan, so we would like to request you to give your update on what's happening on the market. I think most of the markets are volatile. Markets are giving a lot of events and a lot of news which is spreading in the market also. What's everybody have what is the view on now? Whether somebody has to invest now or somebody has to top up. A lot of queries which is jiggering in the mind now. So you can give an about some update on the market of the suddenly what's happened in the portfolio, how it was that and everything also. So, but I think the good part is the specialized portfolio, which is despite of this huge volatility market, last 1 month I think the October month we have seen a huge volatility, but the specialized portfolio has been resilient and stand with a very less negative, which is returns on the even the 2 months also, even the 1 year, which has generated about a 35% return against of 28% of the benchmark which has given. So with that, I would like to hand over to Ms. Gagan. So after that, I request all the participants to type the questions in the chat box so that we can get it from Gagan. Over to Gagan.
Thanks, Suresh. Thanks everyone for joining in. Good evening. I will run you through a brief presentation to summarize the bygone quarter's key takeaways and our analysis of the same, and then we can take up questions. Right. Yeah. So the first slide is a summary of the Nifty second quarter FY25 performance. Bear in mind that the first quarter of the financial year 25 itself was weak, and that was attributed to elections and to the intense summer impacting construction activity, impacting consumption activity. But coming into the second quarter, the performance of corporates has weakened further. And apart from weakening further, it is the slowdown is more comprehensive. It cuts across investment, consumption, and exports, all of the three key domains. You'll find that corporate sales growth for the second quarter for Nifty companies has been a measly 4%. And excluding financials, it's further down at 3%. And then you further split it up between domestic and exports, you find domestic growth is around 7% on sales, which basically implies that export growths have fallen off a cliff. And then coming on to the EBITDA level, again, the EBITDA growth for Nifty companies is at 5%. X of financials is actually minus 4%. And domestic is barely 2%. The same trend, is sort of visible at the PAT level also. So, as I indicated, a very comprehensive sort of weakness across all the three segments of the economy, and this has led to a downgrade in the Nifty consensus earnings. This was also a quarter where a lot of companies reported numbers well below consensus estimates for the quarters. So you'll find Nifty earnings growth pre-2Q FY25 consensus was 12% for FY25 and 15% for 26. This has now been revised down from 12% to 8% for FY25. For 26, the numbers remain more or less the same. So that's the 2Q performance summary. We'll further break it down sectorally, and you'll find that it's obviously, it varies across sectors, but the weakness in 2Q can be seen in automobiles. It can be seen in cement. Automobiles, obviously, less than 150cc bikes is a segment that grew. Other segments have seen a weak demand scenario. Cement has seen realizations getting impacted, and at the same time, it's also seen costs getting pushed up. And then you can therefore see cement cumulative EBITDA for the sector is down sharply at 21%. Financials is a relatively a segment which has done better, although system level growth or the loan growth across the system has slowed down. But barring that and barring some cost pressures and cost of funds, it's still relatively a sector which has held steady or actually done better. Likewise, in infra tech, while there's an anticipation of improvement, growth is still fairly weak at mid-single digits. There is a recovery in the BFSI space, ordering or contract value disbursal, but that is offset by weakness in some of the other segments. Total contract values for the last 12 months don't really seem to indicate too much of a growth. Margins have been improving for the tech sector, and they've utilized most of their margin levers in terms of utilizing the bench strength or subcontract work reduction, or the pyramid workforce pyramid rationalization. So the operating margin levers in tech have been used to a large extent. Valuations too are now on the higher side of long-term means. So there's an expectation of recovery built in, which we'll see whether or not it flows through in the coming quarters. The energy segment too has been weak. Telecom and consumption, at least on top line, seem to have done well. Metals has been weak. Power utilities has been very weak. In terms of profit swings, at the EBITDA level, cement was impacted, and so was energy. I think gross refining margins took a hit in the quarter, and that shows up. So just to narrate this summary of the sectoral analysis, on the BFSI segment, there's a system level credit growth slowdown now towards 11.5 to 12%. Deposit growth has picked up. The net interest margin moderation continues as the term deposit costs have increased. Asset quality in pockets like microfinance and unsecured retail have deteriorated further, but otherwise seem to be stable. In the consumption segment, the new narrative is there's a slowdown across the urban consumption. The rural commentary is relatively more positive, but on a sequential basis, the recovery that was talked of by the corporates in 1Q in the rural demand hasn't improved any further. If anything, it seems to have deteriorated a bit in 2Q. Some limited pockets of growth in consumption in the mass side is on the electrical consumer durable segment, and also some tier 2, tier 3 retail, garment retailing companies like V-Mart have also reported decent numbers. But overall, a slowing down environment in the consumption segment. IT slowdown in the ER&D segment, visible in the downgrade in guidances by the companies in those segment. Some green shoots of recovery in the BFSI discretionary spend, but offset by weaknesses in some of the other segments. And the TCV values of most companies, LTM total contract values, are stable. They're not improving substantially, albeit they're not deteriorating either. Exports, as we talked of, has remained weak. Pharmaceuticals as a segment has overall done well, but then there's a clear demarcation between in the formulations, pharmaceutical formulations, between companies which have an acute therapy focus and those which have a chronic therapy focus. The acute therapy heavy portfolios have seen very weak growth. Volume growth has been very weak. In aggregate, the acute segment would have grown at perhaps 3 to 4% or not even that. Chronic segments done well. The acute segment also would have been impacted by a revision of the prices of some of the drugs which figure in the list of essential medicines. In these drugs, companies are allowed an increase in price linked to WPI, which in the last 2 years was 10% or more for each of the two, but in this year, is virtually zero because of WPI being in that zone, and that would have led to a struggle for growth for formulation companies in the acute space. But API prices have softened, and you can see that in the expansion of gross margins virtually across the board in pharmaceutical formulation companies, and the weakness in sales as well as margins for the API companies, which basically sell the inputs to the formulation companies. The US formulation price erosion is stable at mid to high single digits. Most companies have seen an improvement in status of regulatory status of their plants serving the US geography, barring perhaps Cipla, which has one critical plant still under observations from US FDA. Hospitals in aggregate reported decent numbers, but there's a moderation in volume growth, in the inpatient growth, and a sharp jump in average revenue per operating bed, which is linked to tariff revisions and also linked to insurance agreement revisions, price revisions in the insurance agreements. And quite a few of the hospitals are entering a greenfield or a brownfield capex expansion phase. Last 3-4 years, they've all basically gone through a phase where they've utilized their existing capacities and reached an optimal sort of bed capacity utilization. Barring Apollo, all of them seem to report significant capex for the coming 3-4 years. In case of Apollo, while there is capex, given their current bed capacity, it may not impact their ARPOBs much. Diagnostics have also had a decent quarter, volume growth of 7 to 8% with price improvements of 5% year on year. The competitive intensity from PE-funded or digital native new competition in diagnostics is now abated. The aggressive price discounting by the new companies is no more the case. Autos, as we discussed, two-wheelers less than 150cc was the growth segment. Otherwise, TVs, PCs, all of them have seen muted demand. Rural demand has been better than urban demand, and that shows up in the utility vehicle share going up. GPM for all of these companies contracted. That's coming down to the sales mix, where 150cc or below is growing faster. And also, in a slow growth environment, discounting picking up pace. Auto parts, across the board, the common theme or trend is a strong growth in the replacement market, but a weak one in the OE-driven market. For tires, rubber prices were up and led to GPM pressure. Bearings, aftermarket and railways growth was strong, but this is also an area which has a high salience of traded bearings, and which impacted margins. Chemicals and pharmaceutical intermediates, more of the same that we've talked of in the past. Inventory destocking and pricing pressures continue to negatively impact. Agrochemicals, at least in the domestic market, seem to have seen some improvement in volumes. Prices are down across the board, both in domestic and export markets. Export-heavy companies have further postponed their commentary or their guidance of recovery because of an impending drought in Brazil, which is one of the most critical markets for agrochemicals. Engineering, industrial, and capital goods as a segment reported decent sales growth and margin expansion in industrials and power T&D segment. Order book and inflow have been strong in T&D, but stable in industrials. Just to give you, some more flavor of how the B2B and B2C segments of the market have done, you find wires and cables seen a good revenue growth in aggregate of 24%. Order inflow growth of B2B companies has been healthy, but volume growth across quite a few of the reported segments is sort of deteriorating. You can see it in the ports data, in the tiles and power generation and cement and pipes data right across the board. And worst obviously have been LCVs and MHCVs. In the B2C segment, on the premium segment, again, a mixed trend. SUV volumes have grown well. Aviation, while it's deteriorated sequentially, at least is still reporting growth, while the other segments, are reporting a drop. You can see it in the PVR footfalls in real estate volumes. On the mass B2C segment, green shoots in apparel and green shoots in the quick service restaurant format. Also in the Zomato gross order value. ACs have done well, and that's down to a very intense summer. FMEG basically refers to white and brown goods, which have done well. But otherwise, there's weakness in footwear, cigarette lighting, staples and paints actually very weak. This slide just breaks down the composition of the Nifty earnings growth for FY 25 and 26. For 26 and 25, you can see financials, contribute to a very large chunk of the incremental earnings growth. For 26, between financials, tech and energy and metals, bulk of the incremental earnings growth flows through. And that, sort of gives you some idea of potentially where sector rotations have of late happened and where they can happen in the future. This is a comparison of the current Nifty valuations vis-a-vis the long-term average, and you can find the Nifty forward valuations are at parity to long-term valuations. While that may be the case for Nifty, that is not necessarily the case across the board. we'll further sort of decompose the Nifty valuation sectorally, and you can find that there are pockets of relative undervaluation, which is in banks, in diversified financials, in oil and gas and related consumable fuels, and perhaps transportation. But then this has to be looked in context of the earnings growth and ROEs offered by these sectors, and then if you triangulate all the three, which is earnings growth, PE, and ROE, I think you'll still find that diversified financials offer probably the best combination of earnings growth, relative undervaluation, and good ROEs basis these estimates. Obviously, there are sectors like healthcare services and construction materials which offer very good growth, but healthcare services, which is largely coming from hospitals, the valuations are a bit of a stretch. And for construction materials, this year has been weak, and obviously on a weak base, you can see strong growth in the coming couple of years, but ROCs are relatively lower. Perhaps one other segment which offers the same combination of good growth, ROCs, and relatively decent valuations would be telecom services. So that is how it looks when you decompose the Nifty valuation across sectors. Further sort of drilling down into valuations, while Nifty is at parity or a slight discount to its 5 or 10-year valuations, the Nifty mid 150 or mid 50 are at steep overvaluation to their 5-year means. In the small cap segment, the overvaluation is relatively less than in the mid cap segment. Pharmaceuticals, while absolute valuations on a TTM basis are high relative to 5 or 10-year means, they are at parity, and therefore there's a relatively less risk of derating in the pharmaceutical space, and earnings growth still seem healthy for the coming year or two. IT already bakes in a certain amount of anticipation of recovery. Valuations are higher than 5 and 10-year means, whereas earnings growth, albeit improving, are still very moderate for the IT segment as a whole, perhaps closer to 9 or 10% for the next 2 years. FMCG, growth's been weak of late, but now valuations have almost bottomed out, perhaps a little more room, and then from a valuation standpoint, the FMCG as a pack will not have much of a downside risk, and perhaps as there is recovery, as the recovery plays out in the consumption space, this might be a sector to watch out going ahead. Consumer durables, fairly expensive, both in absolute and relative terms. Financials, as we discussed, is a space which is at a discount to 5 and 10-year means, and offers relatively good combination of earnings growth and valuations, and clearly a space which will be targeted for over-indexing as far as sectoral strategy is concerned. The PSUs are still at a steep premium to their past historical valuations. This gives you some idea of the foreign portfolio institutional flow. Obviously, October has been a month of very heavy outflows. That's obviously there is the push factor, which is the overvaluation across the board in the Indian equity markets. But at the same time, there are pull factors, election outcomes in US and the mandate of the incoming government, of clearly benefiting the corporates in US through tax cuts and through duty structures, clearly meant that money would flow back into the American market. In November, the outflows have abated somewhat. This is the net inflow trends of the mutual funds, and you can see, a clear sharp jump in 2024. And the momentum that's been building since May is maintained, and if anything, strengthened further in October. This gives you a decomposition of the mutual fund flows across categories. So in 23, you'll find there's a sharp jump in the small cap fund flow. In 24, the sectoral and thematic fund flows have seen a very, very sharp jump, and there's recovery in the flexi cap and large cap in some measure. So again, sort of indicating as to where the markets figure rotation is due in terms of valuation, price value equation. The SIP gross flows keep on increasing. The net SIP flow trend is maintained. This is an interesting slide. You'll find the unique investors in mutual funds. Data shows, the unique investor by values sort of remained stable between 2019 to 21, and between 21 to 24, it's virtually doubled. So a very large chunk of the mutual fund investors, almost half, are very new to this game. They've tasted success, but they haven't had, a historical perspective of, the bull and bear markets. So, I mean, that perhaps explains the optimism in the markets, even at fairly elevated valuations. Coming on to, the portfolio construct. The portfolio, 40% is large cap, mid and small, put together 60% small at 35. Sectoral decomposition, we've over the last 2-3 quarters deliberately tried to drift towards relatively safer spaces, which we thought were in healthcare. We've reduced exposure to industrials and defense, and in the current construct, it's fairly diversified across segments. These are the stock actions we've taken to date in the portfolio. We've in the past discussed most of them at length. Perhaps Mazgaon Docks is the last one which is entered and which we can discuss. Mazgaon, the idea behind putting Mazgaon in was largely, a very strong impending order pipeline. So this is a company which reported 9,500 crores of sales last year. Currently has an order book of 40,000 crore, which is executable in 4 years, and which has already been declared L1 for 3 further Kalvari class Scorpene submarine orders, which in 2017, 3 submarines were at an order value of 27,000 crores, and obviously will be inflation adjusted, so will be more than that. They're already L1, and it's just a matter of time before that order is closed and disbursed to them. Furthermore, there are 6 submarines in the P75I class with an order value which could exceed 60,000 crores, for which Mazgaon and L&T are in the fray, and which is to be finalized in the next 1 year. There's also in the pipeline further repeat orders for P17B frigates, which could be, almost 28 to 30,000 crores. next generation corvettes, which is a 30,000 crore order, which will be split between L1 and L2, and Mazgaon and GRSC will be the two companies bidding for it. And then subsequently next generation destroyer orders, which could be 70,000 crores, but which are further down the line. But all in all, a very strong pipeline for the company to grow from. They have also reported margin improvements. Part of the margin improvements obviously come from better utilization of their capacities. Part of it comes from the shipbuilding life cycle, where towards the delivery phase of the orders, there is a reassessment of the initially budgeted costs, and if the costs end up lower, they're written off and lead to margin expansion. So Mazgaon in the past used to have margins of 8 to 9%, which went up to 12, 13, and last year to 15%. And this year, they've reported almost 22, 23% in the first half. And they indicate, that they can potentially maintain what they reported in the first half. So that's the investment thesis. Clean balance sheet with a net cash of 4,000 crores, which is free cash, including advances. The total cash on books is 14,000 crores, zero debt. Since they service the Indian Navy on negotiated orders, by and large, the terms are very decent, both in working capital and margins for them. This basically gives you a temporal drift of the portfolio, over time, and you'll find our exposure in infrastructure, which at peak was almost 40% or more, is sort of tapered down. Healthcare exposures have gone up, utility exposures have gone up, all with the thought of building in, more resilience in the portfolio in terms of less volatile growth and bringing in more stability to the portfolio. This is a highlight of the quarter's performance for the portfolio, which was very strong compared to the Nifty companies. This has also been skewed by a very strong performance of one of our holding companies, which is Transformers and Rectifiers India Limited, which has seen almost virtually a doubling of their quarterly sales rate because of very strong order inflow in the transformer space. And also because of a shortage of capacities, the pricing remains very strong, which has led to improvement in margins. They have also of late announced a backward integration in one key raw material, which is cold rolled grain-oriented steel, which goes into transformers, and therefore, further building up cost competence. The earnings estimate or growth estimate for the portfolio is sizably higher than the Nifty companies for both 25 and 26. In terms of portfolio capital efficiency metrics and growth metrics, both are healthy. Obviously, it gets reflected in the PE ratio as well. But then at the same time, PE to growth is still sort of 1 or less than 1. And that would be a sanity check at this point in time for me. This is a highlight of the performance across the years. Year to date, we've been able to go and to be ahead of the index thus far. So that concludes my presentation, and we can take questions.
Thank you, Gagan. I think the explanation was in detail for the covering of earnings, covering of the in terms of the where the movements has happened, and especially the earnings, the sector wise, which will has given a means. So I request all the participants who would like to ask a question, they can put it in the chat box so that I'll able to covered and the columns. Yeah. Again, before the questions which will come from the participants, as you cover more on about the things, can you just the first thing which is happening on the market, which anyway we all also have two stocks in our portfolio from Adani Group, which is a port as well as the energy solutions. So if you look at can you just try to brief us how this event will impact these two companies? Is that event is very serious, or what will be implication? So can you just explain to all our customers in a little bit detail?
So, I mean, our understanding is that the indictment, which has been announced, has been person specific, not company specific. So the indictment is of, three people. None of the companies are specifically mentioned in the case, apart from Adani Green, where related to which the investigations have been done. So the portfolio companies do not figure in the indictment any which ways. The second or third order effects possibly could be, a bit of an interim challenge in financing the growth. So they were looking to fund the growth, through overseas investors. If that doesn't go through, and off late, there's been a downward revision of the credit ratings. The question is, some of the over-levered companies of the group may face some challenge in maintaining their growth momentum. How do they go about funding these gaps now? Part of it will come from, an expedited sale of stake in Adani Wilmar. At least that's what they seem to indicate. As far as our two companies in the portfolio are concerned, Adani Ports is very comfortable in terms of leverage. So I don't see, growth being an issue or funding being a challenge for the ports. For Adani Energy Solutions, they are levered up, but most of their midterm expansion plans are already funded, right? So it is only, projects which perhaps bear fruit 5 years or ahead of 5 years, where funding might get delayed somewhat. So that is the only takeaway as far as I'm concerned on the fundamental aspects of these two companies. I don't see this impacting their immediate or even the midterm growth. Perhaps longer term, some delay in Adani Energy, none in Adani Ports at all.
Good. So basically will not have impact on more on these two companies. The funding level, everything has been funding also. Okay. Thanks for that. Second is as the global events which are happening on can you also cover on that one, the elections of US which has happened recently, then second about China, which is stimulus package which has happened, third about the currently the disturbance on the Iran-Iraq, that space point of view. So how you're looking at these three events comparatively, how it is going to impact on the Indian markets. So is that have an impact on the Indian currently? Is that will also lead to the earnings downgrade?
Okay. So, the two disputes which have led to almost regional wars in the Middle East and Ukraine, Russia, the impacts, the two impacts that we have seen of this, one, it obviously the shipping transit time increases because now you can't use the Red Sea route for shipping. So basically companies are talking of a shipping transit time increasing by almost 30 days, which means that they need to keep more inventory on their books. So that leads to a deterioration of working capital. You'll find virtually across the board, most companies have reported an increase in their working capital. So there's a deterioration of working capital for most companies because of this. The second issue is that, Israel and Russia and Ukraine were all large suppliers of defense equipment in terms of Russia and Israel. Ukraine was a very large supplier of gases which go into the semiconductor supply chain. And both Russia and Ukraine are very large suppliers of fertilizers, especially potash fertilizers. They're also very large supplier of cereal grains. So these are areas where, these issues have led to supply chain disruptions. And consequently, if you look at what's happened as a fallout of the Ukraine-Russia war, Ukraine's been funded and supported in terms of weapons supply by European Union and US, to the extent that now both of them have seen their own stocks depleting, which basically means that there is a demand for weapons across the board. The inventories have run down across the board, not only in these countries, but in a lot of other countries which depended upon these countries for their weapon supply. So that gives a very good opportunity for the Indian defense companies to get a toehold in the international defense market. So you can see that, Bharat Forge has been supplying consistently to Armenia, starting with Armenia buying out Pinaka rockets, following it up with the towed guns and the radars. You will find Bharat Dynamics export order book has moved up substantially. They now have a $250 million export book, and they have two contracts of $200 million plus, almost close to finalization in exports. Missiles is a space where I think potentially Indian exports can do very well, at least in the tactical missile space. Obviously, the MTCR means that beyond the tactical missiles, it'll be a little difficult and challenging. Also the fact that the Indian armed forces, almost 70% of their equipment is of Russian vintage, and the Russian supply chain is now completely closed because they are looking to sort of replenish their own supplies in their war, which means that a lot of equipment now has to be sourced locally, which is obviously leading to, or has led to, a good order inflow jump in most of these companies. Obviously, in the last 3 months or last 6 months, elections have led to some slowdown. But if you look at 2-3 year trends, that has been a favorable development for these companies. From an Israeli perspective, the Indian public sector defense companies buy out a lot of subsystems, especially electronic subsystems, electro-optical subsystems from Israel. That supply chain has led to a disruption, which has led to a disruption in their execution of certain missile orders, which were up for delivery, and which have now been postponed to the Indian Armed Forces. So that is, the outcome of this development. Does it stop once the wars sort of stop? Because from a policy perspective, the incoming US government has clearly stated that they don't want to continue, this festering war in both these two territories. Even if it stops, it still means that the NATO countries have to replenish their stocks. They've learned it the hard way that dependence on America for their security comes at a very high cost. Germany is running a recession now. Germany's industry, which used to be fed on cheap gas from Russia, has had to buy same gas from US at 4 times the price. That's virtually made them uncompetitive in a host of domains where they were very strong. Tyson Group announced 11,000 job cuts today. PKMS was up for sale to a private equity some time ago. BASF has clearly indicated that their largest complex of chemicals in Germany is no more cost competitive. So these are long-term repercussions, which obviously mean that supply chains will shift elsewhere, right? As a consequence, you've started hearing the narrative of a euro, an EU plus one, and a China plus one, right? These are narratives. Have these narratives distilled down to concrete contribution to top lines? Most companies seem to indicate you will start seeing that in 12 to 18 months. Stock prices have already moved in anticipation. So you can see it in pharmaceutical CDMO companies, right? Where the Biosecure Act announced in US basically intends to cut down dependence on Chinese vendors in at least the biologic drugs and to some degree in the chemical drugs. And already it reflects in the steep price increases of stocks like DVs and Shilpa Medicare or even Laurus for that matter. The numbers have yet not come through, but already the narrative is being built in or imputed in the price. So that's the other sort of fallout of these developments. The latest that you hear is the announcement in US of an increase in duties on goods coming from China, Mexico, but not from goods coming from India into US. So perhaps the relative advantage for Indian companies in specific domains, not across the board, but in specific domains might increase. But it's a bit jumbled up. So for example, if the pharmaceutical companies of India stand to gain out of the Biosecure Act and they stand to gain out of, import duty structures coming in their favor vis-a-vis China, they also depend heavily on China for their APIs. How do they, sort of tackle that conundrum? I do not know. But it may not be as simple a case as it seems to consider that the apparent gains may actually fructify as soon or as comprehensively as thought.
Thank you. Thank you for the three things point of view has covered it. It's indirectly is benefiting a lot of Indian companies to develop their defense, pharma, other things point of view also. That's a great which is explanation. Now, if I you mentioned it in the quarter results, okay. There are some finance companies which you segment the quarter 2 was done better and FY26 also is looking very good. But if you look at in our portfolios where we don't have any finance exposures, so are you looking into the further to as a valuations point of view to enter, or can you just give that why we are not part of that?
We have two positions in finance, right? We want to expand that. We've now sort of built up a 5% carry. The idea was to first get the cash and then, we've shortlisted a few companies and we want to build up exposure in that space. So
great.
We've now got some cash which we intend to deploy there.
Great. So, which is the customer's query which is coming is, I think on the performance side, you're done a great job of 1 year and 2 year than the benchmark point of view, correct? But the customers have a exposure into some of the other schemes in the market or some of the mutual funds where in a 2 year and 1 year and 3 years basis, they have seen the higher upside of more alpha than the benchmark, which is about anyway. That's a completely the expectation of the customer is completely right. So when you look at some of the schemes has given a higher and higher return than the benchmark. So is that question is coming from the repeatedly from the customers is so you why could not able to participate some more stock to get a alpha, or uh, do you feel that did you miss the part of the rally in the last 3 years?
No, point well taken. I understand that if they have seen relatively, better gains in some of their other investments, uh, this question is justifiable on their part. Let me, just sort of go back a little in the past. If you look at, how this market has performed in the last 5, 7, 8 years, uh, there's a clear, a clear shift, right? So 5 years ago, perhaps not five, maybe 3 years ago, uh, the quality companies were the ones, where investments were generating alpha. The last 3, 4 years, there's been a very strong capex revival. So if you see, government-led capex has grown by almost 25% CAGR in the last 4 years. It's only in this year, first half, that it's dropped down year on year 15%. This year being an election year also, and obviously, there are other compulsions. So there's been a sharp rotation. Uh, uh, is that rotation something we can capture right off the block? Very difficult. Portfolios take time to sort of turn around and build up. It's only a gradual process. Also, at the same time, our investment philosophy also creates certain guardrails within which we want to operate, which sort of has filters on capital efficiency, on moats, uh, on sustainable profitability, and so on and so forth. And you know, one could say that it would, if you ditch all of this, it would have been easier to make that transition. But it is then also to be understood that investment philosophy has to be there as our basic guiding light and basic guardrail. You cannot throw the baby out with the bathwater. Uh, have we entered a phase now where that relentless growth in the capex cycle will continue? May not be the case anymore. Uh, Valuations are stretched right across the board. So sector rotations have already been done at one level. So from here on, return generation is very, very stock specific across sectors. So what I'm essentially trying to say is that what stood us in very good stead a few years ago, and which you would have rewarded by investing in us, perhaps held us back to a certain degree. But it's partly DNA, it's partly investment philosophy, and I believe market runs in cycles. Those funds which today have outperformed stupendously would have underperformed 3 or 4 years ago equally stupendously. Uh, in aggregate, returns across 10 years might not be as staggeringly different there.
Thank you, Gagan. I think that because of the high quality, high growth, might be, I think we can a clear example of last 1 and 2, 3 months, where the Nifty or the companies which is -6%, -7%. That I think I think the customers can look at that last 3 months and 2 months. We are cushioning the portfolio with a very high resistance because of the might be this is a short term, but I think the long term point of view is very important. I think what you mentioned is very apt on that. The cyclicals, we have to pass through all the cyclicals. Yeah, thank you, Gagan. So then in the portfolio, if you look at, it's about nearly 20% of the exposure to pharma and healthcare together, which is whether it's a 3 or 4 companies. I think this is something uh, like you can put it in a very simple way. I think you're a little covered, which is benefiting because of the a lot of other people's. So you are so bullish on the pharma, or in terms of the which is last 2 3 years is undervalue is going to play now. How you are looking at that sector, because 20% is a good exposure.
Yeah. So, I will answer that in a combination of sector tailwinds and stock specific picks that we've made. Okay. So one of our exposures is polymedicure, right? It is in the healthcare space relatively a unique play because in the listed space, healthcare consumables, perhaps this is the only company right now. Uh, so, it's a company which has 2/3 of its sales coming from the intravenous cannulae, which are used every time anyone gets an IV fluid. Uh, uh, so this is largely a consumable. Uh, Interestingly, I mean, their growth is not dependent uh, on one market. So for them, they are the strongest growth market currently is EU for them. Uh, they have defended uh, patent infringement cases from MNCs like B. Braun in Europe. B. Braun has a turnover of 4 billion euros, and is largely supplying medical consumables and is in the same space. Uh, Having done that, and obviously they have cost arbitrage. Uh, there was a phase where they initially built up entry in the European market. Today they have references, and European market is a 3-year rolling tender market from hospitals. Increasingly, having demonstrated product quality, they're getting more and more hospitals in their ambit. They're winning more tenders because they are cost effective, which means that their growth in Europe is still at almost 35 to 40%, and they indicate this can be maintained because they're adding more hospitals, and the existing set of hospitals is now asking for more equipment. So they used to supply IV cannulae. Now they've been asked to supply blood bags, syringes. Uh, they've also been asked to supply, you know, intensive care unit equipment, which they are building up. So that's one part of their growth, which is building on their references and taking share in Europe. Secondly, as I said, they're adding new products to their basket. Products like dialysis machines, dialyzers, where they've seen good growth this year. In India. Again, in India, this is largely an imported equipment. Obviously, there is a huge gap in supply versus demand. We are diabetes central in the world, and dialysis is largely a required for kidney issues, which is largely a comorbid condition with diabetes. So there is humongous demand. There is need for relatively inexpensive domestically made equipment, and that's a gap that they are now filling. So if their ASP in IV cannula would have been 37 rupees, their ASP in dialysis machines is 4 lakh. They're also entering into cardiac related equipment and intensive care equipment where the average ASPs would be 300 odd. So, they are going up the value chain. Their assessment is that margins in these domains are much higher than what they're currently servicing. In fact, the company talks of a potentially 500 basis point or more margin improvement in the next 4 5 years as their capexes in these domains start yielding revenues. So this is a company where top line growth can remain north of 20%. And because it is going to come with higher value added products, it will come with margin improvements. Obviously a very good earnings growth possibility for a fairly long time horizon is available. So that was the investment thesis. In the other two pharma companies, While there are sector level tailwinds, in terms of softer API prices, uh, in terms of a relatively stable growth sort of environment, there are also stock specific issues. So, for example, MCure is something we picked up. So, MCure increased its MR field force, that is the sales field force, very substantially in the last 18 months by ramping it up from 3,700 odd to almost 5,500 or more. At the same time, they've built up 4 new manufacturing facilities. So there's a lot of OpEx which is already in the books now. And ideally, if they are going to be able to show reasonable growth on the top line, that should come with an improvement in yield per man in the sales force per month, and also operating leverage coming in from the utilization ramping up in the new capacities. So their assessment is that current operating margins, which are at around 19%, can easily jump up by 200 basis points. Their yield per man per month is continuously improving quarter on quarter. So that's something we'll keep on monitoring. Obviously, the new capacity utilization has to go up. And then below the EBITDA line, they've used the IPO proceeds to reduce debt, which means their interest costs will come down. Their depreciation expense will not grow in line with sales. It will flatten out because they don't need to add capacity. And they generate a healthy free cash flow of 700, 800 crores annually. So, a top line growth of early double digit can convert into mid-teens or more at the operating level and still further more down at the bottom line. So easily a case of 20% plus CAGR on the bottom line for the next 3 years. The third one was Mankind. Again, in Mankind, the thesis was very simply this, that they have a very strong demonstrated record of creating brands. They have 21 brands in India, north of 150 crores sales. You don't find many companies reporting those many brands with that kind of sales. More importantly, the share of chronic sales is growing. So if the acute sales is growing at 8-9% for them, chronic sales is growing at almost 18-19%. Chronic therapy sales come with 10% or more higher gross margins, which basically means that top line growth will be accompanied with gross margin improvement. Then, they have their sales force in chronic therapy is relatively new and working at a PCPM or yield per man per month of 3 lakh. The benchmark average in chronic therapies is 8 lakh. And obviously this 3 can ramp up further, which means there's operating leverage to be had. So again, simply a case of early double-digit top-line growth translating into more than that at the EBITDA level because margins will consistently improve. In their case, the latest development is that they've acquired Bharat Serums. So Bharat Serums, obviously, the acquisition has come at a reasonably high valuation. They're paying through 13,500 crores. They're raising 10,000 crores of debt, but that's short-term debt. So 5,000 crores of NCDs and 5,000 crores of commercial paper. They generate very strong cash flow, so they intend to repay this debt down. And they believe that, the acquired portfolio can grow at 25% CAGR and see substantial margin improvements because of efficiency, both in procurement and in sales, because they already have a very strong network through which they can distribute these products. So that's largely the case. It's partly the fact that pharmaceutical had some tailwinds, partly coming from companies having margin levers in place, and all of them have good free cash flow generation metrics. All of them have very good balance sheets. So that was the thesis behind investing in these companies.
Thank you, Gagan. So participants, we are on the verge of the closing of the quarterly call session. If any participants have any questions, please put it in the chat box or a Q&A. So we'll be able to put that into the things. I think today we have been covering on the from global to the macros. Everything has been explained by Gagan very well. So we'll just wait for some 30 seconds. If there's no more questions, we can wind up the session today. Thank you. I think 1 minute. I would like to ask. It's been a long time since outflows have been increasing the PMS. What is the concern? Yeah. So I think somebody is asking about the question, which I would like to ask. It's been a long time since the outflows have been increasing in the PMS. What's the concern? So I think I would like to put it very simple way. As Gagan has mentioned about the quality approach, there is a value approach. They're cyclical in nature. So there are the ASK. If you look at here in the space, there's a core and satellite portfolios across the PMS industries. The core, which will come into the high stable, high quality, and long term approach. The satellites have a quality, but they will be in a very short term to take about very profits and the long term point of view also, which is the thing also. So in this space, the industry will look at the movement will happen from core to value, value to growth. These cyclicals will happen for short period of time. But as you mentioned, it's a very long discussion has to happen there. To put it very small, this is cyclical in nature. The changing of styles will happening. But as now the interest rates are going to cut down, which we are seeing that I think already US Fed has done. There are some more the other countries and including of the India, which might happen the next year or now, which you have to wait and see. So once interest rate cut will happen, your high quality, high growth will do very well in the long term point of view. I think you can have a I think we can have a long discussion on that. You can see it. And he's saying is, I think, what is your view on HDFC Bank? You wanted to have a small view before closing the session on HDFC Bank?
No, so my view is favorable. I believe that they're doing a very good job on their liability side, which is what they need to address currently. And simply by arresting the loan growth this year, they're going to improve their CD ratios and start with a clean slate next year from where growth can pick up. Valuations are also very reasonable. So yeah, all in all, ADFC is if the concerned person is invested, he should remain invested.
Thank you. Thank you all the participants for participating in the quarterly con call on the portfolio, specialized portfolio. And many thanks to the Gagan, which has took it very patiently all the questions. I think this helps in terms of to add on the portfolio here. I think as he rightly mentioned, if you look at the portfolio earnings are fantastic than the benchmark. If you look at on that angle, it's the right time to top up the money for long-term point of view in any of the portfolios, especially the specialized portfolio. The customers who have been investing into the ASKs, so they can have other portfolios, they can open up the folio with only 10 lakh. We have other portfolios like Lighthouse, IEP, India Select, Growth. So they can contact their relationship manager to open the other portfolios with only 10 lakh, which with the using of same demat account. With this, I would like to close the on call. We'll connect in the next quarter with the same with the Gagan. Thank you, Gagan. Have a great day.
Thank you. Thank you for your time.
Thank you, all the participants. We are just closing the session now.